Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello everyone, I am Jeremy Mullen and welcome to today's top stock picks. Kevin Cook will follow me with his pick, but first I will be covering GitLab. The stock is a Zacks ranked number 1 with a ticker symbol GTLB. If you are not a tech nerd or know anything about coding, understanding this company can be very difficult. So to simplify things, you can just look at GitLab as an important tool for anything DevOps related. Now, what is DevOps? Well, that can be explained as people working together to conceive, build, and deliver secure software at top speeds. Now, GitLab's platform is a single application that leads to faster cycle times and allows visibility throughout and control over various stages of the DevOps lifecycle. Okay, enough of that tech mumbo jumbo. Let's get into why I like the stock and why I think it's going much higher. Okay, over here we have the profile page for GitLab. As you can see, it's a Zacks rank number 1. Now, GitLab IPO'd back in 2021 and got as high as $137 a share. There was a lot of excitement with the IPO, but as the market sold off in 2022, GitLab dropped to under $30 a share. We are now up 100% off those lows, and the company is valued at $10 billion. You can see that right here. Market cap just under $10 billion. Now we have that rank of 1. Let's look at the style scores. We have a B in growth, but F in momentum and F in value. Valued investors are not going to like this one. If you look down here, forward PE is 490. That is an insane PE. You don't see that much often. So why do we like this stock so much? Well, it's that growth part. We're going to have growth that's going to cut into this PE over time and help that stock go higher. So let's look at the earnings and see why we think we're going to get the growth. This is a chart going back to that IPO. As you can see, we IPO'd up near 1. The IPO price was 77. It gapped up and went all the way to 140, and then we just sold off. We had the tech sell-off. It didn't help, and then we just kind of went sideways until recently we're trying to trend higher. So earnings beats, we beat every time. It just wasn't good enough for the market to take care of that PE. But lately, we're starting to see some really nice beats, 57%, 80% in the last quarter. We went from a negative earnings expectation to a positive and saw 1,000% EPS beat. So that's pretty huge there. Looking closer at that Q4 quarter or that Q4 guide, the guided revenue is higher, and they see 8 to 9 cents, which is above the previous 1 cent loss expected. GitLab also raised fiscal year 24 to 12 to 13 cents versus the 7 cents expected. Customers with more than $5,000 of annual recurring revenues have increased 26% year over year. So solid momentum with those higher end customers. Now, management commented that, quote, GitLab helps improve developer productivity and reduces software spend, which is why our customers are reporting report seeing 7x faster cycle times with GitLab, end quote. So what we're seeing is hiring customers are valuing the cycle time, which is faster than its competition, and they're starting to see momentum with those higher end customers. So as simple as that, that's where they're starting to see some traction. Now let's look at what analysts are saying and where these estimates are going. Come down here on the estimates page, and we want to see the agreement going higher. Yes, indeed, over the last 60 days since earnings, everybody's hiking their estimates. Now we want to see these numbers going higher. And for the current quarter, what happened here is we just saw the hike pretty much match what the guidance was, but that's still pretty spectacular. Looking at next quarter, current year, we've seen a jump here, and next year we've seen a big jump here. So a little pullback recently, but overall, this trend is looking great. And analysts are also raising their price targets. We have Truist raising from $65 to $70. Mizuho raised to a buy from a neutral, has a $73 target. RBC has an outperform and a $70 target. And then Goldman is very bullish this stock. They have a buy with an $80 target. This is up from $70 that they had before earnings. Okay, let's get rid of this screen and look at the chart. Here is the chart going way back to the IPO. You can see the excitement and subsequent downfall, along with the pretty much the whole tech market fell apart in this late Q4 and early Q1 of 2022. And then we just saw some sideways action and capitulation before a nice quarter turned things around. And then we went sideways until the recent quarter, which took us almost way back to these July highs. So that's going to be an important level to watch, that $70 level. We get above that, we can kind of start getting some fresh power up here. So let's zoom in and see why, or we might go higher. Now, you guys who follow me, you know I like the fibs. So I drew a Fibonacci from these highs to the lows set back over the summer. You can see the 61.8, which is this red line, the retracement higher, held 1, 2, 3, 4, 5 times for the shorts. It was a great short trade because we just always came in. However, the recent earnings broke this setup for the shorts. We got some short coverage and new buyers come in. And what happens when one of these Fibonacci's breaks? I target the 161.8% extension. That is up near $100. So big potential move coming here for GitLab. That's a 50% move, over a 50% move there. So we see continued earnings momentum. This is very possible. And, I do sometimes like to put the greedy targets up here. That's the next extension, which is 261. That would be all-time highs. Now, this might take a couple years to pan out, but I wanted to put that up there to show you guys the potential of this technical break of this Fibonacci 61.8 short setup, which is now broken. All right, let's look at a shorter term setup here. There we go. And this is just the setup that I've seen over the last couple of weeks. And the reason that we bought in Counter-Strike, drawing from the pre-earnings lows here to here, we have a 50% retracement. We're back above the 21-day moving average. Now, there's two scenarios here. We take out these lows, we come down to the 50-day moving average. As this 61.8% holds, I would add to my position here. If it breaks, I get a little nervous. And of course, if it breaks 200-day moving average, I'm probably going to be done with it. However, I don't think it will. I think we hold this area. If we do pull back, maybe a market pullback, this scenario plays out. If not, if the market continues to go higher, this will break that 65 level. Remember I talked about that $70 level. I think we can get 73 pretty quickly. And then if we get into earnings and we have a pretty good earnings, we could probably see that $98, $100 level. So you can see why I really like this stock. While I like to buy pullbacks, this is a stock I would be really worried about missing. Not only the fundamentals turning quickly, the chart looks really strong. If this stock didn't have enough tailwinds, Alphabet increases stake back in March in GitLab. So there's potential for a buyout down the road from that big tech company. And it will probably be an underlying bid in the stock just because Alphabet is involved. At the very least, I think a starter position is warranted at these current levels. And from there, you can add a technical support on market pullbacks on the ones I talked about, like that 50-day moving average and that 61.8% retracement are the levels that you want to look out for. All right. I hope you got bullish on GitLab after all of that. That's it for me and my pick. Here is Cooker with his.
Thanks, Jeremy. My top pick is NeoGenomics. NeoGenomics is a small cap provider of specialty diagnostics, especially in cancer detection. Looking at the price chart here, you can see we had a great run in out of October, and we actually bought from my Healthcare Innovators portfolio between 11 and 13 back in October, and basically we're up 50% on our money. And then whammo, you can see December 28th, big down 18% day. This was on patent litigation with Natera. Natera is a maker of prenatal screening technologies, so also in cancer diagnostics. And so apparently the new technology from NeoGenomics called RADAR, for short, is a type of assay that there was an injunction, a temporary injunction against NeoGenomics from further developing or at least marketing that technology. The thing of it is, though, is that they can still do R&D on it. They just can't commercialize it yet while this is still in court. And the most important point is that none of the analysts were modeling any revenues from this new platform for at least 2 years, or at least a year and a half, I would say. So over the weekend, my Bull of the Day article was on NeoGenomics, and so I give you the whole background. So if you just go to Zacks.com and put in the stock symbol NEO in the articles from Zacks.com, you should see Bull of the Day. And this is my article that I published on Friday. And it just goes over the whole thing. It goes over why I originally bought, why I saw it as a value, trading under 3 times sales, and how strong their revenue growth and earnings growth is. And these diagnostic companies are critical now as we enter what we call the era of precision medicine, where you can prevent disease by detecting it early. So think of things like Exact Sciences with their Cologuard test. Well, there's home tests and there are lab tests. So one of the problems with many of the lab test companies is that last year they got really beaten down. They were all down like 50% in the middle of 23 because the FDA proposed a new rule change, a broad rule change for lab developed tests. Well, we bought that opportunity between $11 and $13 in October. So this was a bit of a blow to see the stock fall back this much on the patent litigation with Natera. But I still, now I see that you could say it's fully de-risked, because if analysts weren't modeling any of the new radar platform that they're in contention with Natera, then it's not going to affect revenues or profits. So my article gives all the details, from what happened over the summer with the FDA, and then the patent litigation with Natera. I happen to own both. I own both NeoGenomics and Natera because they're both young, smart diagnostic companies that, they could definitely be on the radar of a J&J or somebody like that when you think about M&A. Let's go real quick to look at the financials on the detailed estimates page, so you can see, companies trading at, 2 billion market cap. Here it is, the Zacks number 2 rank. And so I just want to show you the revenues. We scroll down on the detailed estimates page. They're looking to pack in over 15% revenue growth this year. Next year is projected 8% to cross 600 million. So, that's why you're trading just over 3 times sales, which is pretty attractive for a small player like this. And approaching profitability, but so we have a 71% surge from, a loss of 56 cents in 22 to a loss of only 16 cents projected for the year that just closed, 23, and then approaching break even. So that's nice to see, but you can see how the estimates have moved higher, and there's been no back off in that, even with the Natera news. So that's why you want to take a look at many of these diagnostic companies. Again, if you just go to the quote page for Neo, and if you scroll down, you will find my Bull of the Day article right here, published on 1/12, and gives you all the details there. And again, I own it for my healthcare innovators portfolio, along with Natera and Guardant Health. Thanks for joining us in this week's Top Stock Picks. For more great Zacks research and information you can use right away this week, check out our weekly promotion.